Welcome back to USA Immigration Explorer. If you are a senior living on Social Security, a pension, or retirement savings, or if you are an immigrant building a life in the United States while still connected financially to another country, this is one of those updates you cannot afford to ignore. Starting in 2026, the IRS is implementing changes to tax filing rules that could affect whether you need to file a return, how much income you must report, and how carefully you need to document where your money comes from. Many people assume that if their income is low or if they already filed taxes for years without issues, nothing will change. That assumption could lead to missed filings, unexpected tax bills, or penalties that show up years later when it is much harder to fix. Today's video is about helping you understand what is changing, who it affects, and how to protect yourself by staying informed and prepared. The IRS regularly updates tax rules to reflect economic changes, improved data sharing, and efforts to close gaps where income goes unreported. The 2026 update focuses on clearer reporting of income sources, especially income that does not come from a traditional U.S. paycheck. This includes Social Security benefits, pensions, retirement distributions, and foreign income or assets. For years, many seniors and immigrants were confused about whether they even needed to file a tax return. Some did not file because they believed Social Security was always tax-free. Others assumed that money earned or saved abroad did not matter once they moved to the United States. The IRS is now tightening reporting expectations and improving how it matches information from banks, government agencies, and even foreign financial institutions. The goal, according to the IRS, is consistency and fairness, but the result is that individuals must be more careful than ever. For seniors, the biggest area of change involves how Social Security and retirement income is evaluated for tax purposes. Social Security benefits are not automatically tax-free. Whether they are taxable depends on your total income, which includes not just Social Security, but also pensions, part-time work, withdrawals from retirement accounts, interest, and even some types of non-cash income. Under the updated rules taking effect in 2026, more seniors may cross the threshold that requires them to file a tax return, even if their lifestyle has not changed. The IRS is also placing greater emphasis on accurate reporting of combined income, which is a calculation that determines how much of your Social Security benefit becomes taxable. Many seniors rely on Social Security as their main or only source of income. Others supplement it with a pension or savings withdrawals. A common misunderstanding is thinking that because taxes are not withheld from Social Security by default, there is no tax obligation. In reality, depending on your total income, up to 85% of your Social Security benefits can be taxable. The 2026 update does not necessarily change the percentage itself, but it strengthens the requirement to calculate and report it correctly. The IRS is using more automated systems to compare Social Security Administration records with tax returns, making discrepancies easier to spot. Another issue seniors face is failing to file at all. Some seniors stop filing taxes once they retire, believing they are no longer required to. Under the updated rules, filing thresholds are more closely enforced, and seniors with modest additional income may still need to file. For example, a senior who receives Social Security and a small pension might have been under the radar before, but starting in 2026, that same income combination may trigger a filing requirement. Common mistakes include forgetting to include pension income, misreporting retirement account withdrawals, or assuming that small amounts of interest from a savings account do not matter. These small omissions can add up and lead to notices from the IRS. Immigrants face a different but equally important set of challenges under the new rule. If you are a U.S. resident for tax purposes, which includes green card holders and many visa holders who meet residency tests, the IRS generally expects you to report your worldwide income. That means income earned both inside and outside the United States. The 2026 update places stronger emphasis on this rule and increases coordination between U.S. tax authorities and foreign financial institutions. This is especially relevant for immigrants who maintain bank accounts, investments, or property in their home country. Many immigrants are surprised to learn that having money in a foreign bank account can trigger reporting requirements, even if that money is not actively being used. Forms like Form 8938 and the Foreign Bank Account Report, often called FBAR exist to disclose foreign financial assets. Under the updated rules, thresholds and enforcement around these forms are more strictly applied. Some immigrants mistakenly believe these forms are optional or only apply to wealthy individuals. In reality, the reporting threshold can be relatively low, especially when multiple accounts are involved. Foreign income can include wages earned abroad, rental income from property in another country, dividends from foreign investments, or even certain pensions paid by foreign governments. The IRS does allow credits and exclusions to prevent double taxation in many cases, but those benefits only apply if income is properly reported. Failing to report foreign income does not usually save money in the long run. Instead, it increases the risk of penalties and back taxes, especially as international data sharing improves. The penalties for non-compliance can be serious for both seniors and immigrants. For seniors, underreporting Social Security income or failing to file when required can result in back taxes, interest, and penalties. Even if the mistake was unintentional, the IRS can still assess charges. For immigrants, penalties related to foreign income reporting can be even higher. Failing to file required forms like FBAR or Form 8938 can lead to fines that range from hundreds to tens of thousands of dollars, depending on the severity and whether the IRS believes the failure was willful. These penalties can apply even if no additional tax is owed. Imagine a retired senior named Linda who lives on Social Security and a small pension. For years, she did not file taxes because her income seemed low and no one told her she needed to. In 2026, the IRS system flags her account because her pension provider reports payments that were never included on a tax return. Linda receives a notice asking for several years of back returns. Suddenly, she is dealing with stress, paperwork, and potential penalties, all of which could have been avoided with better information. Now, consider an immigrant named Carlos who moved to the United States and became a permanent resident. He still has a savings account in his home country where his parents deposited money for him years ago. He does not touch the account and assumes it is irrelevant. Under the updated rules, that account crosses the reporting threshold. When the IRS receives information from a foreign bank, Carlos is required to explain why the account was never reported. Even though the money was not earned recently, the failure to disclose creates a serious issue. The good news is that there are practical steps seniors and immigrants can take to stay compliant and avoid these problems. The first step is awareness. Know that if you receive Social Security, pensions, retirement income, or have any foreign income or assets, you should at least review whether you need to file. Do not assume past habits still apply. Tax rules evolve, and 2026 marks a shift toward more detailed reporting. Gathering documents early makes a big difference. Seniors should collect Social Security benefit statements, pension summaries, retirement account distribution forms, and records of interest or dividends. Immigrants should gather foreign bank statements, investment records, and documents showing income earned abroad. Keeping everything organized reduces mistakes and stress. Timing also matters. Filing on time helps avoid penalties and gives you more options if something goes wrong. If you are unsure how to report something, tax software can be a helpful starting point, as many programs are designed to guide users through common scenarios. However, for more complex situations, especially involving foreign income or multiple retirement sources, seeking professional help can be a wise investment. A qualified tax professional can help ensure that income is reported correctly and that any available credits or exclusions are applied. Another important tip is not to ignore IRS notices. If you receive a letter, read it carefully and respond promptly. Many issues can be resolved more easily when addressed early. Ignoring notices often makes problems worse and limits your options. As we wrap up, let's review the key takeaways. The IRS 2026 update places greater emphasis on accurate reporting of Social Security, retirement income, and foreign income or assets. Seniors may find that more of their income is subject to filing requirements, even if their financial situation has not changed. Immigrants must be especially careful to report worldwide income and disclose foreign financial assets using the appropriate forms. Failing to comply can lead to penalties, stress, and financial hardship, but staying informed and organized can help you avoid these outcomes. Staying compliant is not about fear, It is about being prepared. The tax system can be confusing, especially if you are retired or navigating life as an immigrant. That is why channels like USA Immigration Explorer exist, to break down complex updates into clear, practical information you can actually use. If you found this video helpful, please like it, share it with friends or family who might be affected, and subscribe to the channel for more updates on immigration, taxes, and life in the United States. Thank you for watching, and we will see you in the next video.